Well, good morning, good afternoon and good evening, wherever you are at the present moment. To welcome everyone to this ISTAT Learning Lab, where we will have an insightful discussion on global oil markets. My name is Peter Negline. I'm in Singapore with BOC Aviation, and I'm also a director on the ISTAT board with a particular responsibility around the ISTAT online offering. So we're delighted to have with us today Mr. Julian Lee, who is an oil strategist with Bloomberg in London. He's had that role for the last 7 years. With Bloomberg, he provides real-time analysis of breaking news in oil markets. Julian also contributes a weekly column for Bloomberg Opinion, and you can find that on bloomberg.com. He's also obviously, given his background, frequently quoted in many of the Bloomberg news channels. Julian's also been heavily involved with developing the crude oil tanker tracking for Bloomberg in the Persian Gulf and Africa. Now, prior to joining Bloomberg, Julian had a 25-year career with the Center for Global Energy Studies, which was founded and chaired by the former Saudi Arabian oil minister Sheikh Yamani, who sadly died 2 months ago. Whilst at the centre, Julian was responsible for the analysis of the oil and gas markets of the former Soviet Union and Africa. And he also contributed a lot to their work in the Middle East and oil markets analysis and forecasting. Julian also spent 4 years with a mining company in Africa. Julian has degrees in mathematics and operations research, and we're very delighted to have Julian with us. So I'd like to invite Julian to join us and appreciate him, Julian, making the time to present to us today. Now, before I just hand it over to Julian, just one very small thing. You may have seen a note that you are welcome to pose questions. There's a Q&A button at the bottom of the Zoom screen. I would encourage anyone to post questions there, and we'll put those to Julian after his presentation. So, Julian, if you'd like to share your screen, I'd be happy to leave you to present your thoughts and views on the oil markets.
Thank you very much, Peter. I hope everyone can hear me. It's a great pleasure to be with you all, wherever you are around the globe today. Thank you, Peter, for the introduction. I'm going to talk for the next hour-ish about the oil market, about the pressures on the oil market, about this extraordinary period that we have been through and are still going through, and the impact that that has had on all of us in any walk of life, the impact that it's had specifically on the oil industry and on the oil market, and where we might be going from here. I am not allowed to make my own price forecasts. I work within the newsroom at Bloomberg, so I can pull on other people's forecasts, and I will be doing that during the words that I'm going to share with you, but I can't make my own forecasts. So if any of you want to ask me where I think the price of oil is going to go, I will very politely decline to answer that in a personal capacity, but we'll share with you some of the forecasts that we survey at Bloomberg, and I'll end up with presenting some of the views of where oil prices may go over the next 12 to 18 months. So it's been an unprecedented time. The world has been through a period like no other in modern times since the emergence of the novel coronavirus in China towards the end of 2019. And that has hit oil just as it's hit everything else. And what I want to sort of start off with is to show you the impact of this in very broad brushstrokes. 2020 saw global oil demand fall by somewhere in the region of 9 million barrels a day. That's around 9%. And the estimates vary between 8.5 million barrels a day to 9.5 million barrels a day. Figures are still being collated. Demand estimates for 2020 will probably keep changing over the next 3, 4, even 5 years into the future as more data becomes available from those countries that are less good at reporting consumption numbers And so these numbers will get revised, but the broad picture is emerging that in 2020, demand collapsed by somewhere in the region of 9 million barrels a day. And this first chart tries to put that into a much longer global perspective. It's only the 10th time in 55 years that oil demand has actually fallen year on year. And you can see from the chart that the drop last year was at least 3 times as big as the drop that we have experienced in any other year going back to the mid-1960s, and indeed way further than that. That's just as far as the this particular data series from BP goes back. It has dwarfed absolutely everything, and it should come therefore as no surprise that the impact of this has been quite transformational for the oil industry, certainly in the short term, and very possibly in the longer term as well. And if we look at it in a little more detail, we can see that it was really the first quarter of 2020 that on a global scale, we began to see this big slump in demand. By the second quarter, global oil demand was down by 16 to 17 million barrels a day compared with the same period in 2019. We were down with demand below 85 million barrels a day. That's a 20% drop in demand in that quarter compared with what we would have expected to happen. And you can see from the blue line in this chart that suppliers were actually fairly slow to respond to this collapse in oil demand. Producers didn't recognize particularly quickly just how severe this collapse was. They continued certainly through the first quarter, pumping at the rate that they had pumped through much of 2019. And in fact, in April, they boosted supply in that first month of the second quarter. And that had a tremendous impact. But they did eventually get their act together and cut supply, not nearly as much as demand fell. So we still had significant oversupply, even after producers had cut output. But the real depths of the demand destruction were relatively short-lived. Consumption began to recover. By the third quarter, we had recovered close to half of what we'd lost over the first and second quarters. But after that, that recovery really began to slow down. It stalled among a second wave of virus outbreaks, the emergence of mutant strains, and a second wave of lockdowns in large parts of the world. And we can see the impact that this virus and the government responses to it have had through a whole host of data sets that people have started to make available, looking at transport movement, road vehicle movement, passenger flights, and I'll share a couple of those with you. I apologize for the very messy look of this slide. I promise you it's the only one that's anything like as messy as this. But it does, I think, show us some fairly important things. This is real-time traffic congestion data for a range of major cities around the world. It's congestion data that comes from the location technology company TomTom, and they publish these figures on their website for a whole host of cities around the world. And if we look at initially at the US, we can see this very quick drop-off as lockdowns were imposed, as people started working from home. Traffic congestion right across the country from Los Angeles, Houston, Miami, northern cities like New York and Chicago, traffic fell, at least measured in terms of the length of time that it took to do journeys, fell by about 80%. The recovery was patchy. We saw a much quicker recovery in the northern cities than we did in the south and the west. But by the time we got to the start of this year, after we'd been through the quiet period of the Christmas and New Year holidays, we've started to see a much more dramatic pickup in road traffic in the United States across the board as the vaccine program has rolled out, and we are seeing many more people getting back onto the roads, both in the cities and on the interstate freeways. In Europe, we see a very mixed picture. Everywhere except Berlin, we saw a similar kind of drop of about 80% in journey times compared with what people had been experiencing prior to the pandemic. We had this very mixed picture over much of 2020, where congestion in Berlin was pretty much back up at normal levels, indeed in some cases above. Much of the rest of Europe, we continue to see much more muted road traffic, much quieter city streets. And then we've had, again, a very confused picture with, again, some of these northern European cities, London, Berlin, where we've seen a pickup. We've also, in the last couple of weeks, seen the same sort of thing happening in Rome. But we've still got places like Paris, where the lockdowns in Europe have had a huge impact on city traffic. And this, to a large degree, mirrors the recovery in economic activity that we've seen in Europe, which has been much less uniform than it has in the United States. We've seen very different paces of recovery, and that has had an impact on the speed at which Europe has been able to reopen, to travel, to people going back into offices, to work. And we're seeing certainly some countries in Europe that are lagging behind places like the UK, where again we've had a very quick vaccine rollout, and we are starting to see restrictions being eased. Kids are back in school, people are starting to go back into offices, and road traffic is picking up again. One of the things that we've seen, and we've seen this all over the place, is that people have been favoring using their cars and other forms of private transport over public transport. And if we look at the passenger usage statistics on public transport networks around the world, whether it's the underground system and the buses in London, or the metro in New York, or other mass transit systems, we are seeing still that passenger numbers there are well down, whereas for road use, as we can see from some of these statistics, usage is in some cases, and if we take a quick look at China, Japan, and Taiwan, in some cases, road traffic is back up not only to where it was pre-pandemic, but in some cases significantly above, as more people use their cars to get to work and fewer people take public transport. But we can see very clearly, if we look at the Asian picture, the impact of lockdowns in Beijing, for example, where the Chinese government has been very quick to impose restrictions on movement and to limit travel. And we've seen as a result of that, that there have been these significant drops. And we can see the troughs corresponding to lockdowns, in some cases also corresponding to big public holidays like the Lunar New Year, which coincided with more restrictions on movement, people being asked not to travel. And in other Asia, again, we have this very mixed picture. And so what I think is emerging from this is that we're not seeing a pattern of recovery that is consistent across the world, or indeed across individual regions. We can see, obviously, India, this declining congestion representing declining traffic numbers as they go through this truly awful current wave of infections that is sweeping the country. But if the impact on road fuel has been significant, the impact on jet fuel has been even more so. Commercial flights fell by about 75% year on year in April. They are still down, they were still down by about 50% in August. And even now, a year on from the start of the pandemic, when people are talking much more about recovery and opening up than they are about closing down and restrictions, even now, commercial flights are still round about 30% down on where they were at the same point in 2019. The impact on long-haul flights has been even more dramatic than it has on the overall total. The flights that we are seeing returning are significantly skewed to domestic flights, whether that's within North America, within places like China, and it's skewed away from international flights and long-haul international flights in particular. And this is going to be one of the keys, I think, to the pace of recovery in oil demand, is going to be the extent to which international travel is opened up, both by road, by rail, but most importantly, by air. And one of the things that I think it's important to recognize is that from an oil perspective, the impact has been very different because of these differing impacts on various areas of economic activity. So the impact on different fuels has varied very greatly. This chart shows the demand for three broad fuel groups: gasoline, middle distillate fuel oil, and jet fuel in the United States. And I've used the United States because that is where the data is most readily available. They publish estimated data on a weekly basis, which means that it's a good way of getting a consistent view of fuel demand across various fuel types. So the distillate fuel is predominantly heating, industrial process heat, and heavy trucks. And we can see that even in the depths of the pandemic back in the spring of 2020, yes, there was undoubtedly a dip in consumption of distillate fuel oil, but it was far less dramatic than it was for other fuel groups. And the total market for that in a normal period is close to 4 million barrels a day. Gasoline demand, which in the US is almost entirely private vehicles, that took a big hit in the sort of April-May period. It began to recover over the early part of the summer, and then it has sort of stalled at about 90% of pre-pandemic levels, and these are compared with the corresponding week in 2019. It stalled at about 90% of comparable 2019 consumption, right up until the last month or so, as the vaccine rollout has gathered pace, as some of the restrictions have been eased, and people are starting to travel much more. In jet fuel, we can see that consumption of jet fuel fell to about 30% of pre-pandemic levels over the early part of the summer. It recovered, but only to about 60% over the late summer, the autumn and into the winter. It picked up a bit over the Christmas and New Year break, fell again, and has now picked up again with the combination of spring break, Easter holidays, the vaccination, and people feeling a lot more comfortable about traveling, at least within the United States and perhaps some of the Caribbean islands. And that has had a big impact on jet fuel. And one of the things that it's worth bearing in mind is that for the oil industry as a whole, this different speed of decline and the very different recovery patterns for the different fuels create some quite interesting headaches for refiners in particular, because refineries make a mixture of products. You can't put a barrel of crude oil into a refinery and get a barrel of gasoline out at the other end. You get a mixture of gasoline and distillates and heavy fuel oil and all sorts of other products. And to some extent, you can tweak the relative proportions of each of those, but you can't eliminate one or another entirely. And what this has meant is that even as refinery runs were cut to meet the overall collapse in demand, we were still globally producing huge excesses of some fuels, in particular jet fuel. And a lot of that initially went into storage tanks, but as it continued, that started to be blended in to the middle distillates. And for those of you who saw the short video at the beginning of this, you'll have noticed, if you were reading the questions and answers there, that jet fuel is most similar in its chemical characteristics to middle distillates, to diesel. And that's where a lot of this excess jet fuel has been soaked up, going into the diesel pool. And in that way, we have avoided becoming swamped in an excess supply of jet fuel. And in the same way that we have seen that the impact on the demand for different fuel types has been very variable, so too has the impact around the world. We can see the blue line here is China, a very muted demand impact overall. Demand fell by about 1 million barrels a day. China is the second biggest consumer of oil in the world after the United States. So that is a very muted impact, partly, I think, because certain parts of the Chinese economy kept running. Yes, they shut down a lot of domestic travel very briefly, but industry kept going. There was a quick move back, I think, to using private cars. Demand recovered relatively quickly in China. By August, it was back up above 2019 levels. And although the growth hasn't been spectacular, it has remained above pre-pandemic levels all the time since August so far. In India, we saw this initial collapse in April 2020. We saw the recovery a little bit slower than China's, but significantly quicker and stronger than in Western countries. India was back at or above 2019 levels by October, but the big question is what's going to happen to Indian demand in April, May, and are we going to see a significant drop in Indian demand when this month's figures come out, and if the restrictions that we're seeing in India now are extended into May and perhaps into the summer months. Demand in Europe and Asia, Europe and the Americas was much harder hit. It began to recover, but has stalled. And again, we're starting to see, I think, here in the last couple of months, again, the effect of the vaccine rollouts, the effect of what are at the moment, at least, falling infection rates in many of these countries. And there are big hopes for the summer that we will see a massive pickup both in economic activity with stimulus packages, but also in pent-up demand for travel over the holiday season. And there is a great deal of hope that is being pinned on the opening up of international transport corridors and broader international travel between perhaps between groups of countries, even if it isn't yet a global opening. But demand is only one part of the picture. Supply is equally important, and suppliers, producers have really been playing catch up here. In the early part of 2020, there was a massive bust up between the countries of the OPEC Plus producer group, and this group was the members of OPEC with a group of non-member countries that had since 2017 agreed to support them in making output cuts to try to balance the market in the face of the second shale boom in the United States, which saw a surge in output there. And they had had an agreement that initially was meant to last for the first half of 2017. And by the beginning of 2020, it was entering its fourth year. Some of the countries involved in it, most notably Russia, were beginning to lose patience. And in March, their deal to restrict output fell apart, just as the virus was starting to have its most significant impact on global oil demand. The result was that suddenly in April of 2020, not only did we have the collapse in demand, but we also had a production free-for-all, which saw global oil demand boosted by somewhere in the region of 2 to perhaps 3 million barrels a day, as Saudi Arabia, the United Arab Emirates, Kuwait, and to the extent that they could, Russia and countries like Iraq, opened the taps and put as much oil as they could onto the market. The result of that was that we saw prices tumble. We saw prices falling to $20 a barrel on a day after day basis. And as the contract for West Texas Intermediate closed out, we saw at one point that prices actually for the first time ever went negative. And the reason for that was that the West Texas Intermediate paper contract, where people are trading barrels for future delivery, when that contract closes, if you hold a contract to buy however many barrels of West Texas Intermediate, you have to take delivery of that oil. And as storage tanks were filling up, there were a number of buyers who simply didn't have the space to store it and had to shift those contracts almost at whatever price they could. Even if that was negative, they were paying people to take those contracts off their hand. But it was very much a feature of the expiry of that particular 1 month's contract. And it wasn't perhaps quite an indication of the fact that nobody wanted oil generally, more just that those holders of those contracts had nowhere to store that oil. But we did, in April, to come into effect in May, have a record output cut from the OPEC Plus producer group of about 10 million barrels a day. It was a difficult cut to negotiate. It took them 3 or 4 days to do it, with lots of haggling backwards and forwards, and to the surprise of many people, it was actually Mexico that held out against making the cut. It's interesting to perhaps look at what would have happened had they simply agreed, because falling production in Mexico has meant that they would have been able to abide by their cut without actually having to impose any restrictions on their industry at all. But they chose to dig their heels in. They refused to accept that they would cut output for more than the first month of the deal, and eventually a compromise was worked out, and they implemented cuts of close to 10 million barrels a day in May, and put in place a schedule over which they would slowly reintroduce some of that oil back into the market in a series of increments between the first one happening initially intended to happen in June, all the way out to April 2022. One of the features of OPEC deals in the past has always been that they've managed to agree what they would do, but they've then had real difficulties in implementing it. People would agree to an output target and then largely ignore it. This time has been quite different. If we look at the OPEC Plus group as a whole, their compliance has been remarkably good. I'm sorry, I'm looking at the labels on this chart and I realize they are slightly the wrong way around. The OPEC Plus line, which is the whole group, is actually the blue line. The OPEC 10, which is the 10 OPEC countries led by Saudi Arabia, is the red line. So the OPEC countries themselves have done much better than the group as a whole. Their non-OPEC collaborators have implemented most of what they agreed to do. They've never quite got to where they said they would. And a large part of the reason that that OPEC has done so well lies quite firmly with Saudi Arabia, that has cut its production by even more than it agreed to do. It had originally agreed that it would cut its output to somewhere in the region of 8 million barrels a day, a 3 million barrel a day cut from an agreed starting point. It went ahead in June and cut an additional 1 million barrels a day, and it has continued to cut more than it said it would. And you can see here this again, another big increase in the compliance by the OPEC countries. That again is another additional unilateral cut by Saudi Arabia. And there are several countries within the OPEC group who simply haven't been able to produce even at their reduced target levels because of natural decline and a lack of investment in their oil industries. And if we look at the cuts as they were initially intended, these are the blue columns here. These were the initial cuts that they had planned to make. They delayed easing the cuts in July. They effectively kept the June production level going for an extra month before they eased some of their targets. They did the same, and they're doing the same now. They had initially intended to add 2 million barrels a day back to the market in January. In fact, they only added back 500,000 barrels a day. And since then, there have been a couple of small increments that have been permitted to Russia and Kazakhstan, but everybody else has kept their January target levels. And they are in the process now of slowly unwinding some of those cuts, so that by July, the intention is that they will be back where they had intended to be in January, in a series of incremental small increases each month. But they will still at that point be holding close to 6 million barrels a day of production off the market in an attempt to try to get things back into balance and to draw down some of the excess stockpiles that built up as a result of their slow response to the collapse in oil demand. And these yellow blocks are the extra volumes of oil that Saudi Arabia has cut unilaterally on top of what was agreed as part of the OPEC Plus deal that was made back in April 2020. But it's not just the OPEC Plus countries where we've seen production come down. The United States has seen its production come down very significantly. But it's worth noting that while the pandemic and the price collapse that happened alongside the collapse in oil demand has certainly accelerated the drop in US oil production, it's worth noting that output had actually peaked and was drifting very gently lower from November 2019. By that point, the shale producers were only adding sufficient new wells to be able to offset the natural decline in production from their existing well stock. And it's a feature of the oil wells in the shale that the production rates decline very, very steeply. And so you might lose your production rate might be half the initial rate within 3 months of starting a well. And that compares with a conventional oil field where you might hope to get several years of plateau production before you start seeing very significant declines. And what that means is that to keep the shale producing, you have to drill more and more wells as your production goes up to offset those very steep declines from a growing number of legacy wells, what a number of people have referred to as the Red Queen problem from Lewis Carroll's Alice Through the Looking Glass, of having to run faster and faster just to stand still. And they had reached a point towards the end of 2019 where the shale producers were coming under increasing pressure from their investors and their lenders to start making a return on those investments, to start giving some money back and to stop chasing growth in volume at all costs. And that was when we started to see that the production, both in the shale and in the US more broadly, reached a peak and started to plateau. And what we are seeing now is that even with a rebound in oil prices, and this is the red line here is the West Texas intermediate oil price, we can see that by March that was pretty much back up where it had been at the beginning of 2020, back up somewhere slightly above $60 a barrel. Prices have recovered, but the number of wells or the number of rigs drilling for oil in the US is still less than half of what it was before the pandemic. We were up then close to 700 rigs that were drilling for oil. We are now at somewhere a little below 350 rigs. And this is why many people are arguing that unless we start to see a pickup in the number of rigs drilling for oil, we're not going to see a recovery in US production to the sorts of levels that we were seeing before the pandemic. And companies are still under very strong pressure from investors and lenders to show a great deal more capital discipline. We are seeing that shale-focused companies who start to talk in company briefings or quarterly reports about adding new rigs to start drilling more wells, are being punished by investors. We're seeing sharp negative moves in the share prices of some of those who talk about returning to this sort of growth strategy. And I think this is a key reason that we haven't seen as sharp a response to the rise in prices as we saw to the drop in prices, and why we may well not see US oil production rebounding to that sort of pre-pandemic level. There are three fairly significant countries within OPEC that are not part of the current output restrictions: Iran, Libya, and Venezuela. The group agreed that they wouldn't be required to make any production sacrifices because of the difficult situations that all of them faced. Excuse me, dry throat. We can see Iran, the impact of the Obama era sanctions and then the Trump sanctions on production. Production fell by roughly half. A large part of the other half is used domestically in Iran. They have pretty high domestic consumption, unlike many of the Arab countries in the Persian Gulf, because they have a much larger population. We've started to see that creep upwards in the sort of post-Trump era, as the Chinese have been willing to buy more Iranian oil. It appears we're seeing significantly larger volumes being moved out of Iran, very often cloaked, hidden away from the prying eyes of tanker trackers, people starting to rely on satellite imagery to try and track Iranian exports. But there has undoubtedly been a little bit of an uptick as some of the pressure on Iran has eased a little bit. In contrast, we've seen Venezuelan production has fallen from about 2.5 million barrels a day in 2016 to less than 500,000 barrels a day, probably round about 500,000 barrels a day now. When I was working at CGS, Venezuela had realistic plans to boost production to 6 million barrels a day. And that was pre-Maduro, and the election pre-Chavez, the election of Hugo Chavez as president of Venezuela, the nationalization and politicization of the oil industry really put paid to those plans, and the foreign capital flight, the domestic capital flight, and the mismanagement that have continued of that oil industry has led to the collapse in production. Much of the infrastructure in the country has really fallen apart. Some of my colleagues have toured parts of the Venezuelan oil industry, and the images of crumbling pipelines, refineries that aren't working, pumps that have been idle for years is a very sorry picture, and one that means that even if there was a change in government in Venezuela tomorrow, the recovery in Venezuelan output would take years and billions of dollars of foreign investment, which would require a complete transformation of the way the Venezuelan oil industry is run. The third country that is outside the deal is Libya. The revolution that ousted Colonel Gaddafi back in 2011 saw production fall to close to zero. It was restored relatively quickly, but then we've had this long period of internal conflict, of sort of quasi-civil war, and certainly factional fighting within Libya, which really accelerated in 2020. We saw virtually no production through most of last year. The peace deal towards the end of the year has meant that production is back up at above 1 million barrels a day, but that recovery is still pretty fragile. It's another country where investment in oil infrastructure has really lagged what is needed to maintain capacity. And if we don't start seeing money being put into maintenance of the oil industry, of pipelines and pumps and drilling equipment and port facilities, this production may remain relatively fragile. And what all of this means is that going forwards, if we see the sort of recovery in demand that some people are expecting, with a return to 2019 levels by the late summer, possible continued growth through 2020, we're going to start to need much more production to come back on stream. And if we're not likely to get it coming from these countries, and we're not likely to get it perhaps coming from the United States, it's very much going to be down to the producers, the core producers of the OPEC Plus group, who still hold this roughly 6 million barrels a day of spare supply, to react much more quickly to the upturn, or to any upturn in demand, than they did to the collapse. And if we look at stockpiles, this initial slow response of producers meant that in the second quarter of the year, we saw huge builds in inventory levels worldwide. And as production was cut, we started to see that production was cut below the recovering demand level. We started to see the first withdrawals again from stockpiles globally happening in the third quarter. We've seen stocks continue to come down, stockpiles continue to come down in the third, fourth, and the first quarter of this year. But that reduction has been relatively slow compared to the buildup. Now, the OPEC countries, when they met to plan their way forward through their production cuts, decided that they were going to set themselves a target by which they would measure, they said, when they would start putting oil back onto the market, where they wanted to see the market get to before they started making fundamental changes to their production policy. And what they said at the time was that they wanted to see the stockpiles of oil in the developed countries of the OECD back at their average level between 2015 and 2019. And there were some good reasons for picking OECD stockpiles. They are much more visible than global stockpiles. The OECD countries report their stockpiles of oil on a monthly basis, generally with a month or two of lag. So we've got some pretty reasonable numbers in April for the end of February. That, when things are moving quickly, that can be quite a significant lag, but it's a lot better than we have in many other parts of the world, where we either have very out-of-date stockpile numbers, or in the case of somewhere like China, none at all. And so for the OPEC countries, the OPEC Plus countries, this was really a case of setting a target that they could have some realistic chance of being able to measure, rather than one that encompassed the entirety of global stockpiles, which can be argued would have made more sense. If you're looking at a global commodity, you need to look at global stockpiles. But if you can't see them, then I think you're frankly kidding yourself if you try to set a target based on those global numbers. Another part of the argument is that a lot of the stockpile buildup outside of the OECD has been in China, and China, along with several other Asian countries, India included, is in the process of building up a strategic stockpile of oil. Both of those countries are now big importers of oil, and they face the same risks that countries like the United States and other Western countries felt that they faced in the 1970s, that they were becoming increasingly susceptible to the risk of a supply disruption for whatever reason, whether it's a tanker getting stuck in the Suez Canal, or an attempt to close the Strait of Hormuz, linking the Persian Gulf to the Indian Ocean. So the Chinese are building up a strategic stockpile, and the argument has gone that much of the stockpile that has been built up in China has gone into these strategic reserves and won't come out again unless there is a supply crisis that affects China. The one thing that nobody knows is will China use its strategic reserve in a similar way to the US, locking it away until there is a significant physical disruption, or will it use it much more as a market balancing mechanism, taking oil out and putting oil back into it in response to fluctuations in prices? But that was the target that the OPEC Plus group set themselves. They're well on the way to getting stockpiles back to those target levels. By the end of February, they were getting pretty close. OPEC's own forecasts have them getting stockpiles down to that target level in the next 2 to 3 months. So by the end of, perhaps the end of July, perhaps August, but certainly getting them down there within the foreseeable future. And it's not just the developed world stockpiles that are coming down. We can see some of the commercial stockpiles outside of the big consuming countries of the OECD also coming down. Saldanha Bay, close to Cape Town in South Africa, is an important stockpile location. I mean, it's not big compared with the OECD stockpiles, but it's a stockpile that, because of its geographical location, is favored by oil traders, because once you take the oil out of there, you can send it to Asian markets or Atlantic Basin markets with roughly equal journey times. And so from that perspective, it's a very handy place to store your oil if you don't quite know where you're going to send it once you take it out of storage. You can supply markets pretty much anywhere in the world with it. If you store it in Rotterdam, it's great for supplying the European or perhaps the North American market, but it's much less good for supplying the Asian market. Similarly, if you store it in Singapore, it's great for supplying Asia, but much less good for supplying the Atlantic market. So this storage facility tends to be quite a favored location for traders to store oil. And we can see here that since late last year, oil has been pulled out of this storage at a very rapid rate. It's now back down to where it was in April. There's another tanker that's taken another 1 million barrels a day out of this stockpile since this graph was compiled last week. And so this stockpile is continuing to come down. And if we look at the major agencies that forecast oil supply and demand, they are all seeing stockpiles continuing, stock draws continuing this year. They're all seeing supply remaining below demand throughout the rest of 2021. They are all seeing the rate at which stockpiles are drawn down accelerating over the rest of this year. And that, I think, is important, because what that tells us is that they are forecasting that supply is going to remain constrained. We're not going to see an opening of the taps by the OPEC Plus countries. We're not going to see a sudden resurgence of US production. But on the other hand, we are going to see accelerated demand growth. We are going to see the demand picking up over the Northern Hemisphere summer and out towards the end of the year. And that is going to accelerate the stock draws. Now, they all see the pace of this somewhat differently, but that feature is common to them all, that they see the stock draws accelerating, and these forecasts are very much pinned on the recovery in oil demand. So let me sort of finish up with some of the demand pressures that people are seeing. The demand tailwinds, the things that are going to push demand forwards. I mentioned the avoidance of public transport. This is already boosting the demand for gasoline and diesel in private vehicles. The expectation is that this will continue, and that as more people go back to work, people start thinking about summer holidays in the Northern Hemisphere, we're going to get a big boost to the demand for road transport fuels. There's also this feeling that we're all going on a summer holiday, that lockdowns certainly in Europe and North America are easing. There's a pent-up demand for vacation travel that may be by road instead of air, but either way, it's not going to be at home. There are real hopes of air travel being picking up on key holiday routes, perhaps between Europe and North America, certainly within Europe, even if it's not happening worldwide. And we're seeing more and more people getting back to work in the office. That's going to have an impact on commuter travel. It's going to have an impact on the consumption of energy in workplaces, some of which will filter through into oil. And the hope is among certainly among oil suppliers, the hope is that we will start to see a resurgence in business travel, which will also boost oil demand. And I've included this view from Citigroup that came out came out on Friday. Their view at the moment is that global oil demand will hit a new peak, and this is an all-time peak. This isn't a post-pandemic peak, of over 101.5 million barrels a day between April and August, both based very much on this pent-up demand for motor fuels and perhaps for aviation fuel as well, as the vaccine campaigns gather pace. So these are really what is pushing this positive view of demand, but there are headwinds too. The new virus outbreaks in India and Brazil has raised worries that we will continue to see flare-ups in different parts of the world that will restrict international travel. Those new variants may be less vulnerable to vaccines, which may mean that these vaccine rollout campaigns have a short-term effect, but not a significant not a significant long-term effect. And the very different uptake in vaccines against the virus in different parts of the world is going to hamper a global opening and an opening up of I think of long-haul travel. Add to that, there is certainly some reluctance to flying, both from the ongoing restrictions on cross-border travel, the development of travel bubbles that make it possible to travel certain routes but not others, and the mounting costs and difficulties that people face on international travel, which could have a significant impact on leisure travel. the cost of COVID tests, the requirements on quarantine, the longer border checks that have seen 6-hour waits at Heathrow for people coming into the UK, that may have a significant impact on people's desire to fly over the coming summer. And so translating that into oil price outlooks, as I said, I can't give my own views, but I can share with you the forecasts that Bloomberg surveys. These are roughly 20 odd separate forecasts from analysts at banks and consultancies. The median forecast sees oil prices, and this is a Brent crude price, pretty flat at around $65 a barrel out to the third quarter of 2022. The low side sees that perhaps falling back to $50 a barrel. The most optimistic see it getting up above $75 a barrel, towards 80 over the summer before falling back to 70. And I saw another forecast that came out yesterday, I think it was, that suggested that over the next 6 months, Brent could easily get up to $80 a barrel. So that's definitely at the moment the high side. As we are close to a third of the way through the second quarter, the average Brent price so far in April is almost exactly on that blue line. It's just about $65 a barrel on average so far in April. So that's where we are at the moment. And I thought I'd share as a very final slide views on peak oil demand. These are two views separated by about a year from ISTAT Energy, a European consultancy, and they see the peak in oil demand moving closer than they did a year ago. A year ago, they saw it peaking at about 2028. They now see it peaking around 1 million barrels a day lower than they did, and 2 years earlier, as we get a stronger uptake of electric vehicles, of much more significant energy efficiency and insulation taking place in the first phase, an electrification of heavy road transport, perhaps in a second phase, and moving on to a non-fossil fuel based maritime sector, and certainly the inroads that we're seeing being made into the aviation sector. And by 2050, they see now global oil demand 10 million barrels a day lower than they did just a year ago. And so things are changing. They will undoubtedly change again, and maybe not in the same direction as we come further out of what has been a truly unprecedented shock to both oil demand and, as a result of that, to oil supply. I hope that's been a useful view of how this pandemic has affected the oil industry, how demand has responded to it, how we are coming out of it, and where we may go from there. And with that, I will hand back, Peter, to you.
Excellent. Thank you very much, Julian. It's very, very insightful. And I really do appreciate all your time and effort to put the presentation together for us. Can I just a question from me to begin with? I mentioned at the beginning that you had worked at the Centre for Global Economic Studies, that had been founded and chaired by Sheikh Yamani, a former Saudi oil minister. So over the 25 years that you were there, you must have got to know him quite well. And it was interesting, well, as I said, sad, first of all, that he died in February, but interesting to read his obituaries that appeared in quite a number of parts of the press, but you obviously knew him quite well. I'm just wondering whether there's any stories that you'd like to share with us and experiences that you had having worked for him for so long.
Yeah, I mean, you know, there are so many stories. He was a fabulous person to work for. I started working for him in 1989, and I came back from working on the copper mines in Zambia. I'd answered a job advert for someone to set up and manage the computer systems at what was described as a newly founded energy think tank in London. And I had an interview, not with the Sheikh himself, but with a couple of his representatives in an empty office building overlooking Hyde Park, and it was a very strange affair because it was all very cloak and dagger. Nobody would say at that time who was behind it. You know, it was a wealthy Arab investor who was interested in the whole sort of global energy question, and I you know, I took a leap and took the job without knowing who it was, and it was, you know, it was a month or two before I actually got to find out who was behind it and meet Sheikh Yamani, who was over in London. I mean, he lived in various places around the world, you know, in Switzerland and the Mediterranean and Saudi Arabia, and certainly pre 9/11 in the United States, where he was lecturing, and he would spend, you know, he would visit London probably 3 or 4 times a year, and whenever he was over in London, he'd spend a significant amount of time with us. He had a private office in the building that we had, so when he was in London, he'd be in the office quite a lot, and when he was, we would all have lunch together, and he had this very large boardroom table in this lovely sort of Victorian townhouse overlooking Hyde Park, and the staff of the centre would meet with him, and we were a very small staff. There were sort of half a dozen of us, and we'd meet and we'd sit around the table, and we'd spend the entire afternoon there as his you know, his chef would bring out a succession of delicacies for us all to nibble on as we talked about the oil and energy sector, and you know, Sheikh Yamani would tell us his stories of the OPEC meetings of the 1970s, where, you know, they would go on for a week at a time. You know, and my colleagues complain now about an OPEC meeting going on for 10 or 11 hours. You know, some of these, there was one meeting that went on for, I think it was 25 days, with a gap in the middle as ministers had to go back and you know, consult with their governments. And this, of course, was, you know, this was pre cell phones and internet and email and all that kind of thing. So we would hear the stories of that, the you know, the discussions with Henry Kissinger and Jim Schlesinger of the US, and the, you know, the just the network of people who relied on their contacts with Sheikh Yamani to understand what was going on in the global oil world. And yet, you know, here was a man who had, to some extent, shaped, if not actually shaped policy, certainly shaped the way that oil policy was disseminated, and had a big hand in shaping global oil policy for more than a decade during the you know, quite transformative years. And he was you know, he would sit there and listen and ask questions of, you know, me in my by that stage probably in my late 20s, studying the oil and gas industries of the Soviet Union that really nobody knew anything about. And it was that willingness to take on board what other people had to offer, I think that for me really characterized Giuliani. I mean, this was a man who, most people would expect to be so remote, so aloof, so separated, and he was one of the nicest people and most interested people that I ever met, and I miss him. I miss him terribly.
It's a great story. Thank you for sharing. Just to move on a little bit, we have a question from Gary, and if I can just read it to you, Julian. It says here, during COVID, we've seen a marked preference for airlines to deploy smaller gauge, newer technology aircraft to meet whatever demand there is, which generally means a lower fuel requirement. Environmental concerns are also at the forefront of everyone's minds. Given these influences, how do you see the demand for jet fuel developing over the next few years?
I mean, I think it's a really interesting question, and I think that it is, it's a trend that we are, I think, seeing continuing. I mean, obviously, airlines have come under huge financial pressure with the cratering of demand, and therefore, that makes it, the sensible option to go for the most efficient aircraft you can fly, the ones that you can operate at lowest cost. If you've got low passenger numbers, then it makes sense to use smaller planes rather than bigger planes that you're flying three quarters empty. And I think that, I don't see that changing. I mean, I think that once you have gone to the most efficient planes that you have in your fleet, or the most efficient planes that you can get hold of, it seems to me that is a one-way process. Yes, as demand picks up, you'll have to add back, or you will add back more planes, and presumably those planes will start to get bigger as passenger numbers come back. But I think there will naturally be a bias towards bringing back the newest, most efficient, most appropriately sized aircraft as demand picks up and as routes reopen. And so I think that is going to limit the pace of recovery in jet fuel demand. Yes, it will pick up as there are more flights added back, as some of the longer haul flights come back onto schedules. But I think it probably won't recover along the same sort of trajectory as it went down. The planes that are added back will be the most efficient, whereas perhaps the ones that were taken out first were the least efficient. So I don't think you'll get this sort of one-to-one correspondence between the number of flights on the way up and the demand compared with the number of flights on the way down and the demand. I think the demand for jet fuel on the way back up through the recovery will be lower than the same number of flights would have used on the way down.
No, I understand. It does. Am I right in thinking that there's an OPEC meeting on today, or is it this week?
Yeah, there was supposed to be an OPEC meeting on right now, and what happened was in January, when OPEC was initially scheduled to put 2 million barrels a day of supply back onto the market, they decided at that time that the demand recovery wasn't sufficiently well entrenched, and they decided that they were going to add back 500,000 barrels a day, and that they would then meet every month to decide whether they would add back more or keep it as it was, or if it worsened, take more off the market again. And so they've been holding, since January, they've been holding these monthly meetings. And they held one. They held one at the very beginning of April. I think it was actually held on April the 1st, which was not an auspicious day to hold meeting.
Yes.
And rather than hold it at the beginning of May, the beginning of May meeting was scheduled to take place today. And what happened was there was a lot of talk last week that they might actually decide to forego this meeting because at the last meeting they'd set production targets for May, June and July, and they hadn't seen anything a week ago that necessitated any change to that. So they said, well, you know, there's not really any point in meeting, so we'll postpone it, or we won't have it. And then of course we started getting all the news out of India, so people started, the producers started getting very worried about Indian demand, saying, oh no, we have to meet, we have to take this seriously. And before the full ministerial meeting, they have some technical meetings, and so they moved the technical meeting that was supposed to happen this morning, they moved it back to yesterday. And at that technical meeting yesterday, they basically, this technical committee is a subcommittee of ministers. And they basically, it appears, they phoned round all the other ministers who weren't part of this meeting and got them all to agree that they would keep the production plan as they had set it at the beginning of April, so they wouldn't change anything. And so they effectively had the meeting that they were supposed to have today by a series of telephone conversations yesterday. And so today's meeting hasn't happened. So it's this kind of strange situation where they didn't have a meeting. They didn't even, you know, at the moment, their meetings are like this. They're all virtual. There's no face-to-face meetings going on, but they didn't have, as far as we know, they didn't have even a virtual meeting where they were all in the same virtual meeting room. But they did speak to everybody, so they can officially say that they had a meeting and everybody agreed to keep things as they've already had it. So there will be a small production increase from the beginning of May. But it will be, I think it's about 500,000 barrels a day, thereabouts, and a little bit extra from Saudi Arabia as it starts to unwind its most recent 1 million barrel a day additional cut.
I'm glad the meetings have sort of moved around, because I didn't want to be taking you away from something.
Yeah, no, I'm glad
to
too,
your day-to-day job.
It was going to be quite a tricky one for me.
And look, just one final question for you. I know some weeks back you'd wrote an article about, you know, this additional capacity that's sort of that the producers are holding back could be quite a significant pricing factor in due course, right? Is one of the triggers for that? I'm just wondering how you see the whole issue with if Biden can, you know, re-establish the arrangements with Iran. I suppose the sanctions are removed on the basis that they comply with all the nuclear proliferation issues and so forth. How do you see that playing out? Because if Iran does get the right to put more oil back on the market, is that going to then trigger the Saudis or other producers to sort of say, no, we want that market share? Or
I don't think it will. I mean, I think I think the Saudis are well aware that Iranian oil might come back onto the market. We have seen Iranian production creeping up, so clearly small amounts of it are leaking back onto the market now. It's perhaps fortunate that if it happens, and you know, it's still quite a big if it happens, it's likely to happen in a period where demand is increasing anyway. And so I think that they will take the view that they can sort of accommodate that within the overall increases that the group will hope to be making anyway. I don't think that it's going to start some kind of a production war. If one looks at the OPEC Plus agreement, you've got, as I showed in the chart of the cuts, we've got this period between sort of now and July where they are easing some of the output cuts. And by July, they'll get back to where they'd originally intended to be in January. But after that, their deal shows them holding production flat right the way out till April, May 2022.
Okay.
Now, if you take the view that demand is still going to recover over that period, they're going to need to alter that. They're going to need to start putting more oil back into the market. And that, I think, is going to, some of that may come from Iran, but there's going to be room for it, I think. And we're already seeing, increased sales into China. We may well see that a lot of this oil from Iran, if it does come back, actually ends up going to China and going into strategic storage tanks in China. So it may come out of the ground in Iran and back into the ground in China. And so it may have much less of an impact than the headline figures might suggest on global supplies. And we don't know at the moment how quickly Iranian production can recover and how much more they can add. I mean, it may be 1 million barrels a day, it may be a bit more than 1 million barrels a day, but it probably isn't any more than 2 million barrels a day tops.
Okay, excellent. Well, look, Julian, we've taken up a lot of your time. I really appreciate the insights. It's been very, very valuable and very timely, and it's such a fascinating topic, and it's so important to our industry from an aviation perspective. So really appreciate your time, and thank you, and thank Bloomberg for letting you present to us today. Very grateful.
Yeah, it's been my pleasure. I mean, it's always a great deal of fun trying to put something like this together and hopefully telling a coherent and interesting story. So I hope people have found it interesting.
It's been really great. Thank you so much for your time. Thank you.
My pleasure.